For more on all of this, the markets and the tech rally, let's bring in Advisors Capital Management CIO Chuck Lieberman and DA Davidson's Tom Forte. Gentlemen, great to have you with us. Chuck, we'll start it off with you. We are witnessing a market rally on the back of the Fed, opening the door to 2 rate hikes, opening the door to a 6% terminal rate. Does this make sense to you?
Not really, not entirely, but it does reflect the strength of the economy. The Fed is acknowledging that the economy is doing a lot better than they anticipated, and inflation isn't coming down so quickly. So really, the Fed statements and Powell's comments at his press conference are a little bit incoherent in suggesting that a majority of them expect 2 rate hikes or more, and yet the Fed paused. So that's a bit strange.
You know, Tom, when you take a look at today's session, we have some remarkable moves under the surface of almost unchanged on the indices. You've got an intraday all-time high for Apple, for Microsoft, as well as for NVIDIA. So why do you think these stocks are advancing? Is it the notion that these are defensive sectors in a time of slowdown, or is it the notion that things won't be as bad, there won't be a recession, and we're off to the races?
So I think they're advancing because we are much closer to the end of rate hikes. And when you think about the technology sector, you mentioned Apple, you mentioned Microsoft. The fastest rate increase for the Fed funds over the shortest period of time had a material negative impact on technology stocks. It slowed Apple, it slowed Microsoft as well. So I think that it looks like we're at the end of a tightening cycle from raising rate standpoint, and I think that's why you're seeing the rally. I also think that there's a greater likelihood of a less hard landing than a true hard landing. And I think that's also contributing to the strong performance of Apple as an example.
Well, speaking of Apple, Tom, it is, sort of seems to be on a march to a $3 trillion market value, although now off some 41 cents today. But you have a price target of 185, right where we are in a neutral rating. Do you regret that? And why are you neutral?
Yeah, so I think that the shares have had an amazing run. And I think that the Vision Pro, which is the most significant new product launched by Apple since the 2000 iPhone, is already priced into the stock. So I think that there's a lot of good news in the shares of Apple. They're trading at a premium multiple on a PE basis and other valuation metrics. So I think on a near-term basis, I don't expect Apple to outperform the market and have a neutral rating.
I mean, the return, I think if you do the back of the envelope math, Tom, on Apple with your price target, including dividends in terms of total shareholder return, would be less than 5% at this point. Why would you want to invest in Apple at all? You've got a neutral rating on it.
Yeah, so I think right now Amazon's more attractive. Some of the other mega cap tech names are more attractive than Apple. Apple's had an amazing run, but I think there's a lot of good news priced in the stock already. And then I also think there's structural challenges for Apple when it comes to their augmented reality, virtual reality headset, the first being price. You haven't seen mass adoption with Oculus from Meta Platforms at $500. I don't think you're going to see mass adoption with the Vision Pro at $3,500. So I think, for now, I think there's a lot of good news priced in Apple shares, and we'd be more interested in the stock on a pullback.
All right, let's come back to the broader market and the macro economic picture as well. Chuck, given your view of that Fed press conference and meeting, I'm just curious, what do you think in terms of Fed policy and what it means for the likelihood of a recession or not, and or the equity markets overall, which have certainly been rallying very strongly?
Well, it's really questionable whether or not the Fed needs a recession to get inflation under control. It's clear that inflation has come down, but a lot of that is transitory. It's the stuff that ran up because of the pandemic and shortages all over the place. But on the service side, we still see plenty of inflation inertia. So it's not clear to me that the Fed is done tightening policy. Sure, the lion's share of that is behind us. No one expects the Fed to hike by another 500 basis points anytime in the visible future. But a couple more hikes are now built in according to the Fed, and the market doesn't really quite see that. When you look at the economy, there's no evidence of a recession anytime in the immediate future. There's just too much support for various parts of the economy. Boeing is ramping up production. The auto sector is ramping up production. The housing market, which is the most sensitive to interest rates, got hammered last year. but this year we're seeing a rebound in housing. It's clear that consumers have adapted to the prospect of higher mortgage rates. They're ready to pay those. And there's still a shortage in housing, so we need a lot of construction. So the economy is not close to a recession yet, and inflation hasn't come down close to the Fed's target. So I think it's still hard to anticipate any reduction in rates in the visible future.
So this march in technology, Chuck, is that misguided? Is that a bubble that we're witnessing? It sounds, based on what your outlook for the Fed is, that it might be right now.
Well, I think in the case of the technology stocks, you have to look at them one at a time. Some of them are priced at nosebleed levels like NVIDIA, but NVIDIA has an incredibly attractive runway ahead of it. So I think that's a debatable situation. The same with Apple. Apple's product side is clearly slowing down. They're doing well on the service side, but at 30 times earnings at a market cap of $3 trillion, I'm not enthusiastic about it. I find great values in the value part of the market. There are a lot of companies out there trading at 10 times earnings or even lower that are good, solid companies, continue to grow, pay good dividends, and are likely to hike their dividends and buying back shares.
All right. Chuck and Tom, we appreciate your time.
Thank you.
Thank you.